Welcome to the Explainer. I am absolutely thrilled to guide you through our whiteboard session today. We are taking a comprehensive, deep dive into IGCSE Accounting 0452, specifically focusing on the depreciation reducing balance method. But listen, we aren't just doing simple data entry here. Over the next few minutes, we're going to recap essential concepts, walk through a mental worked example using key command words, tackle a pause and attempt practice question, and finish up with some insider examiner tips to help you secure that A-star grade. So grab your markers and notebooks because we have a ton of ground to cover.
Okay, let's jump straight into our A-star blueprint. Here is the agenda. We're covering conceptual analysis, technical execution, ratios and evaluation, and finally, examiner insights.
Section 1, Deep Conceptual Analysis. We're kicking things off with a quick recap of the foundational theory that's totally mandated by the upcoming syllabus. Now, you really need to know that Cambridge is updating its standards. They are demanding perfect usage of modern international terminology. For example, if an exam asks you to state the accounting equation, you have to use terms like irrecoverable debts and owner's equity with 100% accuracy. Gone are the days of outdated phrasing, guys. This section demands that you fully understand the duality of every single transaction, the business entity concept, and exactly how to maintain that fundamental equation at all times.
Think about this scenario. When a question asks you to explain why we charge depreciation, you absolutely must reference the clash between the historical cost principle and the prudence concept. Students frequently make the fatal mistake of overstating their profits by completely ignoring asset wear and tear. It's kind of like looking at your business through rose-colored glasses. When calculating depreciation, especially using the reducing balance method for assets that lose value quickly, you apply prudence to ensure your assets aren't dangerously overvalued.
Grasping the essential vocabulary, words like accrued, prepaid, realization, and consistency, is critical. You aren't just memorizing dictionary definitions here. You literally need these terms to untangle complex, multi-layered business scenarios. When you are asked to prepare an adjusted income statement that involves an accrued depreciation expense, you need to know exactly how that impacts both your profit and your statement of financial position. So why do we care so much about all this accuracy? It boils down to one word: transparency. Remember, interested external parties rely heavily on the integrity of these specific records. Banks deciding on huge loans, owners assessing viability, and tax authorities reviewing compliance all depend on your precise application of these concepts to make their big annual decisions. All right, moving right along to Section 2, Step-by-Step Technical Execution. We are shifting from theory to the mechanical application phase, mapping out the exact procedural flow. Think of this as your operational pipeline. Let's walk through a mental worked example. Imagine an exam question asking you to calculate depreciation using a 20% reducing balance rate on a $10,000 motor vehicle. That transaction starts with a source document, feeds directly into your prime entry books, posts to your T accounts, and ends up in your trial balance. In year 1, you deduct $2,000. In year 2, and this is vital, you must apply that 20% to the new carrying amount of $8,000, not the original cost. This sequence requires absolute methodological precision. Here is a massive tip to secure your method marks. Listen carefully to this. If you are asked to calculate a complex reducing balance over 3 years, examiners will reward your logical flow even if your final balance is wrong. I mean it. If you make a minor math slip early on, but you show exactly how you applied that wrong number correctly through your ledgers, you still get marks. So always show all your workings. Now it's time for our interactive practice. I want you to literally pause this explainer right now. Grab a pen. I want you to mentally prepare a provision for depreciation T account for that same $10,000 vehicle at 20% over 2 years. Go ahead. Pause now and try it. Okay, are you back? Let's see how you did. Did you clearly distinguish between the income statement charge and the balance carried down? In year 1, your balance carried down is $2,000. In year 2, your new charge is $1,600, making your final balance carried down $3,600. Getting your brought down and carried down balances backward is a classic, agonizing way to lose easy points. Let's talk about some common calculation traps that trip students up year after year. The absolute biggest pitfall in the reducing balance method: forgetting to subtract the accumulated depreciation from the cost before applying your percentage in year 2.
Other super common mistakes include confusing trade discounts with cash discounts or missing vital state symbols in manufacturing accounts. Avoid these exact traps, and your trial balance is going to hit 100% accuracy.
Section 3. Interpretation, Ratios, and Evaluation. Next, we are elevating our focus from just doing the math to actually interpreting the results. This is where you secure that A star. Let's look at a dramatic shift. An exam might ask you to evaluate a current ratio falling from 2.5 to 1 all the way down to 1.1 to 1. Calculating the ratio is just your baseline skill. Spotting that this massive drop is a blaring red flag for a business's liquidity, well, that is your first step to high-level evaluation. An A-star student doesn't just present the ratio and move on. When asked to analyze the liquidity, they ask the hard questions. Why exactly did it fall? Did the business overpurchase inventory? Are they settling trade payables way too slowly? Or, and this is highly relevant to our topic today, did a massive capital expenditure on new non-current assets completely deplete their cash reserves? Diagnosing the underlying business reality is your true goal here. This brings us perfectly into inter-firm comparison. Imagine you were comparing two rival businesses. Because different businesses use entirely different accounting policies, like, say, one uses the straight-line method for depreciation and another uses our reducing balance method, making direct surface-level profit comparisons can be incredibly misleading. You absolutely have to adjust your perspective based on the specific policies they apply. Furthermore, if an exam asks you to discuss a business's performance, you've got to look beyond the surface numbers at the actual quality of the profit. Your return on capital employed isn't just driven by math in a vacuum. What about staff morale, physical location, market reputation? These are vital elements for long-term sustainability that are entirely unrecorded in traditional accounting ledgers. Finally, Section 4, Advanced Examiner Insights. We are looking directly at official exam strategies, digging into recent principal examiner reports to protect your grade. I want you to really absorb this quote derived from recent examiner warnings. Students often lose marks through poor handwriting in ledger accounts and the failure to distinguish between revenue and capital items. Please take this seriously. Do not throw away hard-earned, highly technical marks just because the examiner literally cannot read your numbers, or because you accidentally classified a capital asset purchase as a simple revenue expense. It happens way more often than you'd think. To help keep you on track, here is your exam strategy checklist. First, monitor your time carefully. Don't spend 20 minutes agonizing over a 5-mark ledger. Second, align your effort with the question's mark weightage. And third, clearly distinguish your capital items from your revenue items before you even start calculating your depreciation. Following this simple checklist ensures your knowledge translates directly into marks. As we wrap up, I want to leave you with a final, provocative thought. If our highly structured accounting records perfectly capture the math of the reducing balance method, how will unseen, non-financial factors ultimately impact your final evaluation of a business's success? Keep that thought bouncing around your head as you review your notes from today's whiteboard session, because connecting hard data to complex real-world realities is what true financial intelligence is all about. Thanks so much for joining me for this explainer, and happy studying.